And I think that's a great segue into kind of when you think about the other ways you can do tax efficient, or what you need to be aware of if you want to be tax efficient in your portfolio, are unrealized gains and losses. So what you just talked about there is bonds can show on paper that it has a loss. They say that's an unrealized loss, meaning you're carrying it in your portfolio. To your point, if you're a bond investor, you bought the bond because you were comfortable with it up front. So unless something has drastically changed, you're planning to hold it to maturity. That all doesn't mean anything. With stocks, the same kind of thing can happen, but it's a little bit different because there's much more risk, right? You haven't locked anything in.
And there's no maturity date.
No maturity date. The stock can go on in perpetuity. So when a stock rises in price, you have an unrealized gain in your portfolio. I think that is where clients, maybe to your point, they see their account value as $1 million. But if you have a $250,000 unrealized gain, you've made a lot of money, but eventually you're going to have to pay taxes on that if you sold your whole portfolio.
Right.
Not on the $1 million, on the amount of money you made. And those sometimes, depending on how they're treated, can be taxed at very different rates.
Right.
I think that's always something to be very aware of, especially for very high income earners. So we talked about bonds, the income there, municipals, the benefits. Well, if you're an equity investor, looking at how long you've held an investment can be very important to the tax picture. So I'll give you an example. Say it's the 31st, December 31st, you buy Apple stock. Over the next year, it goes up 10%. So you have a 10% gain. If you sell that stock within a year, that's taxed at your ordinary income levels.
Right. Which is, if you're a high income earner, it could be in the 40s.
It is insane sometimes how much you can give up in a portfolio's return if you only have a short-term gain. Now, here's the caveat. If you hold it for 1 year and 1 day, so again, I bought it on the 31st. If I wait a full year and buy it and sell it on the 2nd of the next year, market holiday on New Year's, because, we get some days off, thank God.
Right.
That's now taxed as a long-term capital gain. And those rates max out at 20% for the highest earners. So you think about that. You can either pay 40% on an investment if you held it less than a year. If you hold it over a year, you pay half that in taxes. Now, here's the big thing I think a lot of people try and think about is, well, I only want long-term gains then. Okay, that's a great idea in theory. But if you have a crappy investment, is it really worth holding on to a crappy investment just to maybe save some money on taxes?
Right.
I don't know. I wouldn't do that. Not at all. Because I wouldn't want to lose all that value. Again, I want gains. So now there's times where it does make sense. Let's say you decide to sell a stock 3-5 days before it matures into a long-term gain. Might be worth just kind of, saying, I'm going to sit on my hands, be smart in a tax-efficient way. Other times, you might not have that ability to wait. But just like we were talking about with tax equivalent yields, it's all part of the big equation. Is not how do you avoid taxes, but be efficient. So it's knowing the difference between long-term, short-term gains can add, I think, a big value to your portfolio overall. Now we get to talk about losses, right? Everyone loves to talk about losses.
Well, actually, I do like to talk about losses because I think they're the silver lining, right? They're the silver lining of a portfolio that's going through some volatility, right? Because I like to say with losses, if you can frame it in your own mind as, okay, I bought $100,000 worth of portfolio and the market just went down 20%. So now my $100,000 is worth $80,000, right? People will tend to say, I don't want to sell anything at a loss. I'll sell it when it comes back, right?
I hate that.
Oh, I do too, because it's not the right way to think about it. Now, if what you're holding that went down 20% still has great long-term prospects, good earnings, and is just sold off because there's more sellers than buyers, that's one thing. But if you're holding on to losses because the company has changed tactics, earnings have gone down, something's happened in the company, it's being poorly managed, whatever it is, you've got to ask yourself, what are the chances of that already hammered company because of its poor performance? What are the chances of it coming back to what you paid for it at versus selling it, getting into something else that does have a higher chance of making money back? Now, the silver lining there is that when you buy, so let's say you sell stock A because it's not, it's had a problem and the chance of it coming back are low. You buy stock B, it goes back up in value. You can take those losses that you had in that stock and carry it forward indefinitely. So at some point when you do sell stock B, you'll get to at least chip away at some of those gains and not pay taxes on because you're going to offset it with the loss. Versus if you just held on to stock A and it went back, you didn't get anything out of it.